So I want you to imagine trying to translate a geopolitical peace treaty into a spreadsheet.
Oh man, good luck with that.
Right. Like, think about the sheer scale of what that actually means. You've got shifting borders, these incredibly complex diplomatic negotiations, centuries of historical grievances, maybe. And somehow, Wall Street has to take all of that raw human history and like distill it down into a mathematically sound list of which stocks you should buy and which ones you should sell.
Yeah, it really forces a collision between two totally different worlds. You're taking the most unpredictable, chaotic geopolitical events possible and forcing them through this highly rigid, totally unfeeling machinery of global finance.
Because the market doesn't care about the emotions of it.
Exactly. No, markets don't process emotion, they process supply chains, they process profit margins. That's it.
And that machinery is exactly what we are opening up today for this deep dive. So we are looking at a really fascinating, highly detailed global equity strategy report from UBS. And this was published on April 17, 2026.
Very specific timing on that.
Very. And our goal today, the mission for this deep dive, is to unpack their blueprint for how the stock market actually prices in the end of a war. We're going to look at the specific global companies that are positioned to surge and the ones facing a massive risk of collapse if the Middle East conflict is finally resolved.
Which is a huge if, but an important one to model.
Right. And to be totally clear right up front, as we open up this UBS playbook, we are purely looking at the financial plumbing today.
Yeah, absolutely.
We are keeping our own politics at the door. We're making no moral judgments here. We are just tracing the math of how Wall Street analysts view these market mechanics.
Which is really the only way to read a report like this, to be honest, because the core conclusion that UBS presents, it's completely devoid of sentiment.
Right.
They argue that a ceasefire does not just, calm the global markets down. It actually triggers a violent rotation of capital. Like the money doesn't just sit still and breathe a sigh of relief. It actively flees one sector and floods into another.
So a peace treaty acts as this, like massive financial reshuffling. The companies whose supply chains were choked by the conflict, they suddenly find room to breathe. But the companies that acted as safe havens, the defensive stocks that absorbed all that terrified capital, they suddenly lose their armor.
Yeah, that safety premium just evaporates almost overnight. And to understand who gets hit and who benefits, UBS built this very specific methodology. They graded a massive universe of global stocks on a scale from -10 to +10.
Okay, so -10 to +10. What does that actually mean for a company?
So a -10 means your company is profoundly damaged by the ongoing conflict. And a +10 means you are actively profiting from the disruption.
Right, but how are they assigning those numbers? I mean, it's easy to look at, say, a shipping company that sails directly through a conflict zone and just slap a negative score on them. But the global economy is way too tangled for it to be that simple.
Oh, way too tangled. Yeah, that direct geographic exposure, like the physical ships, that's actually a really small piece of the puzzle. UBS relied on 3 distinct qualitative data points to build this score.
Okay.
And the heaviest weight this makes up 50% of the entire score is commodity exposure.
See, my mind immediately goes to crude oil. Like, whenever the Middle East is in the headlines, it feels like the financial conversation starts and ends with the price of a barrel of crude.
Well, sure, oil is the headline, but it is a massive trap to stop there. And UBS didn't. They looked at a huge basket of inputs because modern manufacturing is just hyper interconnected.
Right.
So sure, they factored in refined fuels and liquefied natural gas, but they went way deeper into the invisible supply chain. They looked at petrochemicals, like naphtha.
Naphtha.
Yeah, which is absolutely essential for making plastics. They looked at agricultural fertilizers, specifically ammonia and urea. They even factored in industrial gases like helium.
Wait, hold on. Helium? Why would a major global financial institution care about a shortage of helium? Like balloons.
I know, it sounds funny, but it's a huge deal because Qatar is one of the largest producers of helium in the entire world. And if you are, say, a healthcare company relying on MRI machines, you need liquid helium to keep those superconducting magnets cold.
Oh, wow. I didn't even think of that.
Right. Or if you're a high-tech manufacturer making semiconductor chips, you need helium in the fabrication process.
That's crazy.
It is. So if a conflict bottlenecks the shipping lanes out of the Middle East, you can't just manufacture helium out of thin air. The cost spikes. And suddenly, a hospital supplier in Ohio sees their profit margins just vanish because of a shipping delay thousands of miles away.
That is wild.
That is exactly what UBS is measuring here. It's not just what you buy directly, but whether you can survive if a specific, totally obscure input disappears.
Man, that paints a totally different picture of corporate vulnerability. So 50% of a company's survival score comes down to how badly they need those raw materials.
Exactly.
So what drives the rest of the score?
Okay, so the next 25% comes down to pricing ability. This is basically measuring your power over the consumer.
Okay, so like passing the buck.
Yes. If that helium shortage happens, or if oil jumps $20 a barrel, what does the company actually do? Are they trapped in long-term fixed contracts where they just have to eat the loss? Or do they possess the market dominance to simply pass that newly added cost directly onto you, the customer?
I see. So it's the difference between like a construction firm that signed a 5-year fixed price contract to build a bridge versus an airline.
Perfect example.
Like if the price of steel goes up, the construction firm just loses money. They're stuck. But if jet fuel spikes, the airline just slaps a $70 fuel surcharge on your baggage fees and they maintain their profit margin.
Exactly. That is the essence of inelastic demand. UBS is measuring whether a company produces something people are forced to buy regardless of the price. And they are also looking for flexible production. So if a supply chain breaks, can the company pivot? Can they retool a factory in Mexico to compensate for a shutdown in Asia? Pricing power really is the ultimate shock absorber.
Okay, so we have commodity reliance, which is half, and we have the power to pass the buck to the consumer, which is a quarter. That leaves the final 25% of the score.
Right, and the final quarter of the score is basically a corporate stress test based on recent history.
Like looking at track records?
Yeah, UBS looked at past supply shocks. Specifically, they looked at how these exact companies behaved during the COVID-19 pandemic, the 2022 Russia-Ukraine war, and the 2011 Middle East unrest.
So they're basically looking for corporate muscle memory.
Yes, that's a great way to put it, because history rarely repeats itself perfectly, but in the financial markets, it definitely rhymes.
Right, right.
The analysts basically asked, did this company's leadership panic in 2022, or did they have existing risk management protocols? Did they actively hedge their fuel costs? Did they maintain higher inventory levels just in case?
So proving they can handle it.
Exactly. If a logistics company successfully navigated the complete breakdown of global shipping during COVID-19, well, they've proven they have the operational agility to survive this current crisis.
Okay, but wait. I'm just looking at the sheer volume of data required to make those assessments. Like, you're talking about reading decades of earnings call transcripts, analyzing obscure supply contracts, mapping global helium dependencies, and reviewing pandemic survival rates for thousands of individual companies.
Yep.
There literally aren't enough hours in the day for human analysts to manually crunch that kind of qualitative data.
Which is exactly why they didn't.
Wait, really?
Yeah. Buried in the appendix of this report is a detail that fundamentally changes how institutional research is conducted today. To process this massive web of data and assign these scores, UBS deployed a large language model. They used AI.
I have to pause on that.
It's a big deal.
So an AI is reading historical supply chain reports, parsing out who complained about naphtha prices during a random 2022 earnings call, and spitting out a geopolitical vulnerability score.
Yes. It is a profound shift in market analysis. Now, obviously, the AI tools underwent human review, and the final scores were cross-referenced with traditional financial metrics. But the heavy lifting, the qualitative synthesis of millions of pages of corporate text, that was driven by an LLM.
Wow. That forces us to look at the market completely differently.
Right.
Because direct exposure, a ship physically turning around to avoid a conflict zone, that's obvious, anyone can see that.
Right.
But this AI-driven methodology proves that the real danger or the real opportunity is buried in the layers. It's the inelastic demand, it's the hedge fuel contracts, it's the reliance on Qatari helium.
Exactly. And that brings us to the actual results. When this AI tool chewed through all that data and spat out the scores, a very clear picture emerged of who actually benefits from peace.
Okay, let's unpack this. What does a winning company look like in the real world?
According to the blueprint, the prime beneficiaries are the companies that scored below a negative 2.5.
Okay.
These are the businesses the model identified as being severely choked by the conflict. Since the escalation in February, these stocks have heavily underperformed the broader market.
But UBS didn't just dump every struggling company into a buy column, right?
Yeah.
I mean, a company could be underperforming just because they make bad products.
Oh, crucial distinction. Yeah, they didn't just take the AI's word for it blindly. They applied a strict financial filter over the AI's results. They only highlighted stocks that currently hold a buy rating from human analysts.
Ah, I see.
And, crucially, they have to be trading cheaply on their price to earnings, or PE ratios, relative to their historical norm.
Let's anchor that term for a second for everyone listening. Think of the PE ratio as like the height premium you pay for a stock.
That's a good way to look at it.
If a stock has a really high PE, you are paying a massive premium for future growth because everyone is hyped about it. Right now, UBS is saying these beneficiary companies have zero hype. Their geopolitical environment is so bad that investors have basically abandoned them, meaning you are buying their underlying profits for pennies on the dollar.
Precisely. They are fundamentally sound businesses trapped in an artificially depressed environment. And when we look at the specific companies that made the list, the themes become very obvious.
Okay, who made the cut?
In the United States, UBS flagged Southwest Airlines, General Motors, UPS, and Procter & Gamble.
Okay, General Motors is a great example of those hidden layers we talked about because you wouldn't immediately think a car manufacturer in Detroit is sitting around waiting on a Middle East peace treaty.
Right, it doesn't seem connected.
But if you trace the mechanics of a modern vehicle, it's not just steel anymore. It's thousands of complex parts, intricate global logistics, and massive amounts of plastics for the interiors, which requires petrochemicals like naphtha.
There's that naphtha again.
Yeah. A ceasefire unclogs the global logistics network, bringing those obscure material costs down, and suddenly GM's profit margin on a truck expands dramatically.
Exactly. And you see the exact same logic playing out in Europe, only magnified. The European beneficiaries are heavily dominated by travel and aviation. You've got Lufthansa, Ryanair, Continental, the travel tech giant Amadeus, and Accor, the major hotel group.
Which makes sense. Europe's physical proximity to the conflict zone makes them hypersensitive to airspace restrictions and imported energy costs.
Yep.
If a peace treaty is signed, the math for an airline like Lufthansa changes overnight.
Completely.
The fuel gets cheaper, the flight paths literally get shorter, and the tourists return.
Yep. And the same mechanism applies in Asia. The report highlights some heavy industry like Nippon Steel, but it heavily leans into discretionary travel, so ANA, Japan Airlines, Interglobe Aviation in India. It also highlights Sands China and Galaxy Entertainment.
Oh, the major players in Macau casinos.
Yep.
Yeah, they rely entirely on wealthy tourists being able to fly cheaply and feeling economically secure enough to gamble. So that tracks perfectly.
But identifying a good company is only part of the strategy here. The report introduces another metric when evaluating these beneficiaries, and honestly, it is arguably the most important mechanical concept in the entire document. It's called crowdedness.
I love this concept. Okay, think of a crowded trade, like a massive cruise ship where all 3,000 passengers suddenly run to the starboard side to take pictures of a whale.
Right.
The ship stays afloat as long as they stay there, but the balance is incredibly fragile. If the whale disappears and everyone stampedes back to the port side at the exact same time, the sheer weight of the crowd shifting all at once can actually capsize the boat.
That captures the danger of momentum investing perfectly. In financial terms, a crowded stock means too many institutional investors. The massive mutual funds and hedge funds, they are already holding it.
They're all on one side of the boat.
Exactly. If a stock is highly crowded, the consensus is already baked into the price. There is literally no new money left to buy in and push the price any higher.
So if you were looking for a stock to surge on the news of a ceasefire, you want to find the empty side of the boat.
You want the empty side. You are looking for stocks that are less crowded than their respective MSCI indexes.
And the MSCI index is basically just a giant basket of stocks that represents the average market.
Right. So if a stock is less crowded than the average, it has massive room to run. UBS points out that in the US, Southwest Airlines is uniquely uncrowded compared to the broader market.
Interesting.
In Europe, Lufthansa, Continental, and Accor have plenty of room for institutional money to flow in.
And what about those Asian travel stocks you mentioned?
Fascinatingly, almost the entire Asian beneficiary list, ANA, Sands China, Japan Airlines, is currently sitting totally empty. The institutional money hasn't moved there yet.
Oh, wow.
So if the geopolitical weather clears, the upside potential for those specific companies is mathematically massive.
But wait, here's where it gets really interesting. Because the global market is a closed loop, right? If billions of dollars suddenly flood into airlines and hotel chains on the news of a ceasefire, that capital has to come from somewhere.
Yep.
Which means there is an entire sector of the economy currently being propped up by the conflict itself.
That is the harsh reality of the seesaw. If there is a peace dividend, there is also a risk of peace. And under the UBS methodology, the companies facing the highest risk were the ones that scored above a positive 4.
The ones the AI determined were fundamentally benefiting from the crisis.
Exactly. They have outperformed the market significantly since the conflict began. But UBS applies the same financial filter here, just in reverse. They screen for stocks that are now rated neutral or sell by human analysts, and crucially, they are trading at historically expensive PE ratios.
So their hype premium is totally maxed out. They're basically priced for a permanent state of global crisis.
Yes, and if you look at the names, they're exactly what you would expect. In the US, it is the massive defense and aerospace contractors. Lockheed Martin, RTX, which is the parent company of Raytheon and L3Harris. You also see materials and energy names like Alcoa and SolarEdge.
Okay. What about globally?
Europe shifts slightly more toward energy and commodities, though defense is still very present. You have Glencore, the massive commodity trader, energy utilities like SSE and EDP, Norsk Hydro, the aluminum giant, Brentag, the chemical distributor, and Leonardo, the Italian aerospace contractor.
Wow, quite a list.
And in Asia, the list is narrower but tells the exact same story. China, Shenhua Energy, which is a massive coal mining enterprise, and Hindustan Aeronautics, an Indian defense company.
But let's look at the actual mechanism of a sell-off here. I look at a company like Lockheed Martin or Glencore. These are entrenched, highly profitable global behemoths.
Oh, massive companies.
Why are they at such a high risk of a severe violent reversal? Just because a ceasefire is signed. I mean, a peace treaty doesn't bankrupt a defense contractor. They still have decades of government contracts on the books.
Oh, they don't go bankrupt at all. But remember, the stock market does not trade on present reality. It trades on future expectations. And this connects directly back to your cruise ship analogy.
Okay.
During a global crisis, defense contractors and commodity giants act as the safe side of the boat.
Right. Every mutual fund manager in the world got terrified by the headlines, sold their risky travel stocks, and bought Lockheed and Glencore for safety.
Exactly. And UBS warns that names like Lockheed, RTX, Alcoa, Glencore, and Leonardo are currently highly crowded relative to their regional markets. The investors piled in because it was a guaranteed return in a chaotic world.
Right.
But because they are so crowded and because their valuations are stretched to historical extremes, the moment peace is announced, the catalyst for future growth vanishes.
The whale disappears.
And everyone rushes for the exit door at the exact same time. When you have a crowded trade and every major fund manager tries to sell their shares of Glencore on the same Tuesday morning to go buy airline stocks, the lack of buyers creates a severe downward shock. The company itself is totally fine, but the fear premium drains out of the stock price violently.
So what does this all mean? Stepping back and looking at this entire UBS blueprint, the ultimate takeaway is really about the mechanical flow of capital. The global equity market is just a giant, interconnected plumbing system.
Yeah, that's really what it is.
A prolonged ceasefire drains the fear premium out of defense, energy utilities, and commodity giants, and immediately pumps that capital back into companies that require a predictable, stable world to function. The logistics networks, the airlines, and the consumer goods.
It is the unwinding of a massive global stress position.
Incredible. Well, before we wrap up this analysis, we need to transition into some required housekeeping. If you found this breakdown of market mechanics illuminating, make sure you subscribe to the channel because our next deep dive is going to be even more exciting.
And as a formal reminder, the content of this deep dive is strictly for research and analysis purposes. It is based entirely on the historical reporting, data, and methodology of the April 2026 UBS Global Equity Strategy Report. This discussion does not constitute any personal investment advice, and you should always consult with a professional regarding your own financial decisions.
To leave you with a final thought to ponder. We started this deep dive talking about the sheer complexity of translating human conflict into a spreadsheet. The mechanics of helium supply chains, inelastic demand, and crowded trades, they all make logical sense. But the detail I keep returning to is that large language model.
Oh yeah, the invisible analyst in the room.
It really raises a profound question about the future of finance. If institutional banks are now using AI to instantly read thousands of earnings calls, synthesize global supply constraints, and score companies on these complex geopolitical risk factors, when the market violently rotates on the news of a ceasefire, are human investors actually reacting to the reality of peace, or are we now simply reacting to the AI's mathematical interpretation of peace?
That is the question that will define the next decade of market strategy.
Well said. Until next time.